Hey everybody, I hope you all had a great holiday season. Happy New Year to all of you. This is your 2025 market review. So for those of you that are newer to watching these videos, the reason I put these together each month is to give my clients the straightforward information about what's going on in the stock market and the economy, and then ultimately how that affects their investments that I'm helping them manage. So what I'll do is I'll look at a number of different charts. I have 4 different charts we're going to look at, both kind of tying in what happened last year in 2025 and then also looking ahead to 2026. So the first chart that I have is a chart of the S&P 500 rate of return for the year. We were up 16% this past year in the S&P 500, which is your 500 largest stocks out there. Another really good year. This is following both 2024 and 2023 that were both about 25% gains in the overall S&P 500, which to give you a good idea of like, well, what's an average? On average, the S&P 500 since 1950 has made about 10% with dividends reinvested. So, that's kind of a good ballpark average to, clue in on. So another reason that we had a really good up year, technology was one of the best performing sectors in the S&P 500. That also happens to be the largest sector in the S&P 500. A lot of that growth was a result of the continued prospects and growth around AI, and a lot of these companies kind of gearing up for that and looking to generate more money in that realm. So another great year for the markets. The chart that I have here that you're looking at now is looking at not just the S&P 500, but a number of different indexes and asset classes in the markets overall. So the NASDAQ is the top one on there, the very top of the chart with about a 25% gain. NASDAQ is predominantly more technology-based companies. You have your S&P 500, which I was just talking about, the S&P equal weight, which is just it takes all of the different companies in the S&P 500, and instead of giving a higher weighting to companies that are larger like Apple or Microsoft or Nvidia, what it does is it makes all of the companies, the smallest one is the same weighting to the index as the largest ones. So it's something that is a way to kind of see how are the small companies doing, which this past year smaller companies didn't do as well as the larger companies, predominantly because your larger companies are going to be more tech oriented and they benefited a lot because of the AI boom. So Europe and UK and emerging markets all did really well. Japan also did really well. This was one of the first years in over 15 years where international markets outpaced US-based markets, which there's definitely been a lot of underperformance in those different stock markets versus ours, predominantly because they just don't have as many technology companies as we do. But a good sign to see just across the board that markets and stocks are doing really, really well. Bonds, which is measured by the 10-year Treasury, they were positive for the year, only up a few percent, but still positive overall. Gold was the biggest performer, up close to 70% for the year. Bitcoin was the only negative performer, down a few percent for the year. So overall, a really good year for assets as a whole, which is a great sign for anyone that's an investor that's watching this, or that's looking to become an investor that's watching this, or invest money that's watching this. So one of the reasons, and this was something that I came across this past month, I always talk about when people are asking me like, well, is this a good time to invest in the markets? When you're investing in the markets, especially when you're just trying to just get money working for you, the best time to invest money is always probably yesterday, but looking forward, the best time is right now. And the reason being is because markets statistically are on your side to grow. So if we're looking at this chart here, this is just showing your chances of the S&P 500 returns over a specific time period, over a day. It's about a little over 50%. 1 month, the S&P 500 is up statistically a little over 60. 1 year, it's up close to 80%. Over a 5-year time frame, it's also up right around 80%. If we stretch it out 10 years, that's where you're getting into where it's about 93% chance that you're going to be positive over that time frame. And then historically, there has never been a 20-year time frame when stocks have been down. So it's obvious that there's better times than others to get invested, like bottom of 2008 or lows of 2009 would have been great times. Middle of March of 2020 also probably would have been a good time because we were just going through that COVID drop off. But in the grand scheme of things, that's like timing things perfectly, which in reality, to wait for one of those events, you're going to miss out on all of the gains that come before then. So it's better to just get money invested. There's ways that we can get money invested safely to avoid downside drops. I've talked a lot about that in previous market reviews, using tools like options-based strategies to mitigate the downside risk to markets or indexes like the S&P, but still participate with the upside of the S&P 500 and other indexes like that. So if you want to have a deeper conversation about that, if you're newer to watching these videos, I can schedule a call with me. We can chat more about that specifically. If you're a client of mine that's more conservatively invested, you're already invested in those options-based strategies. So we can talk more about that if you're unsure how those work too. So one of the last charts that I have here, kind of looking ahead at 2026 and where we're at for earnings estimates, which the stock market's always looking 6 months to 9 months ahead of where are stocks or an individual stock or the overall market, where is it projected to, like, what are the earnings projected for that company specifically? Take for example Apple, just because I'm staring at an iPhone right now. So if we take for example Apple, and they can analysts will project out, well, what are the future earnings potentials for or estimates for Apple for 2026? And there's all kinds of estimates out there, either on the high end or low end, but we have a general idea of what it is, and then that's how people are investing based around that. So this chart that I have up here right now shows the different sectors that are out there, and then the growth estimates in a percent rate of return standpoint, what's expected for that over the next 12 months here into 2026. So for the overall market, the expected earnings growth estimates are about 14%. A really good sign, because what that means is that if the value of the S&P 500, of what the price that people are willing to pay for the S&P stays exactly the same, and we get that 14% earnings growth, we're going to get a 14% move higher in the S&P 500. So there's always the fluctuation of, well, what are people willing to pay for that earnings growth. So right now it's a little over 20, I think it's like 23 times earnings is what investors for the S&P 500 are willing to pay. For different sectors, that's called a multiple. For different sectors, there's higher or lower levels. Like if we're looking at, say, consumer staples, for example, which is the earnings estimates for that is in the single digits. That's because it's companies like Procter & Gamble and Kimberly-Clark, and companies that really aren't, they're not going to make some dramatically evolutionary product that's going to drive revenues to some extreme level. So if you're thinking Kimberly-Clark, that's paper towel, toilet paper. Procter & Gamble, guarantee you have some of their products under the sink. There's not going to be a lot of growth in companies like that. So their multiple for their company also isn't going to be as high versus information technology, like for example NVIDIA, which is the chip, the most probably like highly valued chip company out there, which is based on their market cap at least, because they are so far ahead in the AI segment of semiconductors. So, is a company like NVIDIA going to have a higher multiple to it than Procter & Gamble? For sure, because there's a lot more growth potential to it. So that's also why you see, information tech has a 25+% estimated growth rate. So a good sign is that materials and industrials are also up there pretty high Materials would be, think of like lumber or anything really going into a house. The steel, that could be, there's just any company that's making things like that are going into buildings. Think that sort of stuff. It could even be, products like Sherwin-Williams, that's, paint. So, but that's a good sign that the earnings estimates for that are as high as they are, and that expectation is at that level, because if there's a housing boom, that's going to be a really big impact for the whole market and materials especially. So that's just kind of looking ahead of where things are at. I think I get a lot of the questions around December of like, well, where do I think that markets are heading? And right now, there's no signs that the market's going to slow down. Obviously, if there were, stocks would already be discounting that and be going down. My expectation for stocks is that we're going to see continued growth within it. There's not a reason that is obvious that momentum is slowing down. Looking at charts of the overall indexes and sector performances, there's a lot of potential momentum moving higher. So that's a great sign for the market to continually keep moving higher, especially in the short term right now. So I'd expect to see continued movement in that direction. So obviously there can be events that happen that cause economic turmoil. It'll be interesting to see kind of how the takeover of Venezuela and the oil industry there and all of the transition that'll happen with that, and how that'll affect our energy companies here. Companies like Halliburton or Chevron or Schlumberger that are big oil producers and that could potentially benefit from being able to actually get into Venezuela and get market share within there. That could potentially be a really big thing for those types of markets, but obviously that's still early phases here. So I'm shooting this January 6th or 7th, whatever. Yeah, January 6th, it's a Sunday. So all of that just kind of shook out here over the weekend. So we'll see how that plays out here over the next month, and I might be talking more about that then next month. So I appreciate you all taking the time to check me out. If you have questions, I know there's a number of you that I'm doing Zoom investment reviews with this month. If we didn't meet in person in Pennsylvania last month, we're probably doing a Zoom review here this month if it's that time for you. If you'd like to do an investment review and we haven't connected here in a number of months, feel free to reach out to me if you have questions or would like to go over anything specifically in your financial world. More than happy to help out in that way. If you have friends or family members that are interested in having a conversation about their investments because they'd like to improve on it and make the returns that you guys have made as clients, happy to talk to them and help them out with getting their money growing as well, or at least just guide them in the right direction, even if they're just needing help maybe with a 401k through work or something like that I can't directly help them manage. But just connect us and we can chat more from there. So I appreciate you all taking the time to check me out. Until next time.